Welcome to BARR Financial Services market commentary for the second quarter of 2012. Many hours of research go into each commentary, and we hope you find them insightful. Please share this information with your friends and family. As I speculated in my last commentary, the summer months, especially April and May, proved volatile and challenging. The big word of the day is uncertainty and raises many questions. The saga in Europe continues with no real long-term solutions being brought to the table. Does this mean that some countries will leave the Eurozone? What about the debt ceiling debate later this year? Who will win the election in November? Will Congress jump off the fiscal cliff at the beginning of 2013? Are we heading into another recession? In this environment, we expect markets to remain choppy and news-driven going into the November elections. The domestic markets had a positive first quarter but gave some back in the second quarter. All major global equity indices finished the second quarter in negative territory. For the current quarter, the S&P dropped 2.8%, which brings the year-to-date return to 9.5%. The stock market rally, which expanded and contracted 3 major times since March of 2009. The overall growth of the S&P is up 116% and is only 3.4% below the peak reached in October of 2007. Global markets also declined during the quarter, with the EAFE index down 6.9% and emerging markets down 8.8%. which brings their one-year track record down to a negative 13.4% and a negative 15.7% respectively. The Eurozone remains the epicenter of weakness and continues to point to a deepening recession. The U.S. corporate sector remains strong and provided a good earnings season. They still maintain high cash reserves, borrowing costs are at an all-time low, financial leveraging has dropped to the lowest level in 3 decades, and the S&P earnings per share is higher than pre-recession. The current situation has made equity valuations seem reasonable, with the forward PE ratio of the S&P index at 12.3 times compared to the 20-year average of 16.2 times. Also, the current PE ratios are all well below their averages. As indicated by the chart, large cap blend stocks are 25% cheaper than their historic averages. We believe this has set the stage for continued expansion. Real gross domestic product, GDP, for the first quarter came in lower than expected at 1.9%, and GDP for the second quarter was 1.5%. I feel the slowdown has more to do with uncertainties that we face rather than underlying business fundamentals. The economy has to grow around 3% a year to bring the unemployment rate down significantly. We anticipate GDP to finish out the year around 2% and expand by 3% next year. On a positive note, we have exceeded the lost output during the recession by $165 billion. The Conference Board's leading economic index, LEI, for the United States declined 2 of the last 6 months. The Coincident Economic Index, CEI, a measure of current economic conditions, has risen slowly but steadily in the last 3 months. According to Ken Goldstein, economist at the Conference Board, and I quote, "The U.S. economy is growing very slowly. The CEI basically reflects the steady but soft pace of overall economic activity. The LEI is pointing to no strengthening over the next few months as the economy continues to sail through strong headwinds domestically and internationally." End of quote. Eurozone. The market has overstated the effectiveness of the policy actions in Europe and underestimated the possibility of a more severe recession. We expect the economic downturn to worsen, which will exacerbate the sovereign debt crisis. This will cause further downgrades of sovereign debt and the European banks. Core European economies also continue to show signs of weakness, indicating that they are not immune to the crisis engulfing the region. There is no short-term solution, which means the world economy will have to grow despite the situation in Europe and all of its consequences. Greece will most likely leave the Eurozone sometime in 2013. The consumer. The Consumer Sentiment Index rose to 79.3 in May, the highest level since October of 2007, before pulling back in June. Confidence among U.S. small businesses rose to a 14-month high in April. Even the service sector continues to show signs of recovery, which is important as it is one of the largest contributors to the economy. Add to that the drop in all delinquency rates on mortgages, consumer debt, and commercial loans could make the consumer an important part of the self-sustained U.S. economic recovery. Housing. The housing sector finally appears to be recovering. Housing starts increased 6.9%, the fastest pace since October of 2008. Home builders' confidence jumped, recording one of the biggest monthly increases in a decade, and is now as high as it's been since March of 2007. Inventories continue to decline, and residential investment has now added to economic growth for 4 straight quarters. That has not happened since the go-go days of 2005. These are all positive indicators that the housing market has turned the corner. For housing to make greater strides, though, unemployment has to come down significantly. Employment. The unemployment rate edged back to 8.2% as labor market improvements seem to slow down somewhat. Companies are reluctant to hire new employees due to global and domestic economic and political uncertainties. Hiring will most likely resume once pending policy measures clear political hurdles and companies have a better vision of the quarters ahead. Then and only then will corporations take that leap of faith that we have discussed in our prior commentaries. There will be tremendous opportunities when this occurs. Closing thoughts. The drums of uncertainty have never beaten stronger than now. There's plenty to worry about. The Eurozone issues, the slowdown in China, the debt ceiling debate and fiscal cliff, our stalled government, the election and pending tax increases, and don't forget about Iran's nuclear weapons program. It's enough to make you want to stay home in bed. With all that being said, the U.S. economy seems to be on a slow, continued recovery. With all that has happened over the last year, the economy and markets have been quite resilient. There should be a continued domestic growth even if the rest of the world is slowing down. The market is poised to perform pretty well relative to the rest of the world in the second half of 2012 and likely into 2013. We have many options available to help you prevail during these challenging times and meet your goals. The bottom line is that our portfolios are well diversified and we will continue to benefit as we move forward into the uncertain future. Please contact us if you have any questions or concerns, as we are here to serve you and your needs. Thank you for listening and your continued support.